Welcome to TheoTrade. This is Don Kaufman, April 1st, 2020. You are watching the TheoTrade evening video. 4 minutes left to go inside of the cash session. And you thought the sell side activity was over. Well, the S&Ps right now, the SPOOs are down just about 4%. But it's the Russell that's really catching our attention. It's an all-out crash once again. Almost a 7% move to the downside. We're on a bit of a bounce right now in the broader markets, but I wouldn't read too deeply into this because all we're doing right now is what we term pinging the gravity points. Again, pinging the gravity points. For those of you that have kind of been tuned in to TheoTrade for a considerable period of time, we have really specific kind of concentric levels inside of the S&P futures that we term gravity points. Now, without going into too much detail around the gravity points, let's talk expressly, about those particular levels rather than discuss how we actually pull out the gravity points. Well, we're going to look at the gravity points. One of the things, before I even dive too deeply into that, this is a little disturbing here once again. You got the S&Ps down some 4%. You realize that the S&P futures are only doing 1.8 million contracts. People, somebody forgot to turn on the liquidity switch. We got issues, big issues. And it's all about, again, the fact that volume, it is non-existent in this broader marketplace. Now, what you're looking at here on this particular chart happens to be none other than these gravity points, but this is on a 30-day, 1 hour. And when I say we're pinging the gravity points, I talked about these specific levels just the other trading session where we said, all right, if we come off the 25.75 level, it is a straight shot down to where? This is 24.66. Now, one of the other gravity points, though, that we've got down below over here is 24.38. We hit it, we bounced. I mean, this is just, it's absolutely marquee. From one gravity point, we break off, we head lower, we touch it, we rip from it, And I'll tell you what, at the bell, you could end up actually between gravity points, which just lends itself, again, it just lends itself to your capability of trading in the after hours if the marketplace starts to rally back up again or back down to the gravity point. Now, again, we're kind of stuck right now between a rock and a hard place, but the S&Ps, I'm going to suggest actually come right back up in and around this 24.66 as we hit very close to the closing bell, though. Nevertheless, again, some just hideous sell-side activity in the broader market. One thing I wanted to bring into scope before I go any deeper into this, and we're going to talk about some of the specific positions, because if you missed like, Monday night's video, we had a trade in there that was an absolute layup. It gave you, multiple days to be able to get into it, but that trade is very much in play today. I'll come to that here momentarily. Before I do so, I want to go to the IWM because I made a comment about the Russell. It's just hideous, and it just keeps on coming. The Russell, and it's a huge standout to me, not because it's down some, 36%. Effectively, it is down 36%. Again, this is a year-to-date basis chart, so it's down 36%. It's the fact that it's down another 7%. All right, that kind of catches my attention. It's not. It's the divergence. The divergence between, the IWM. Then we're going to bring up the spider. So again, let's recall that the IWM is down just about almost 36%. You bring up the spiders. They're down some 24% year-to-date basis. And last but not least, the QQQ, which is only down 15%. The divergence here is huge. And I hate to do this again, but I'm going to rip once again. Tech. If you're looking, for what's going to get decimated in the next leg down in this marketplace, it's tech. All right? It's got to be tech because what do you got? What do you got left inside of financials? They're down 37%. I mean, the only thing exceeding the Russell to the downside, the financials are just absolutely hideous. Now, I'm actually referencing there are sectors down more, There's the closing bell. There are sectors down more, than the financials. But for a major sector, this has been leading the charge to the downside, just hands down. I mean, again, take a look right here. You're down some 37% year-to-date basis. When you start looking at what we term the monsters of tech, that's your conglomerate. It's your Microsoft, it's your Apple, it's your Facebook, it's your Amazon, it's your Google. They're still unscathed. And by unscathed, I mean, again, Microsoft. I happen to have multiple short positions on Microsoft. Again, multiple short positions on Microsoft. And boy, that's starting to pay out specifically today, being down 5%. But I just can't help but reiterate, and I do want to show you my Microsoft positions. I've got a duration position out here in June. Again, duration position out in June. What did I do? I just bought a deep in the money put. Just bought a deep in the money put. It's a synthetic, okay, short stock position. And that put's already gone, again, in what? I purchased it yesterday, and that thing has gone from $35 to about almost $44 inside of one trading session. That's something, when I say duration, I'm not closing that anytime soon. Okay, I'm in that one. I'm in that one because if this marketplace is going to continue to progress to the downside, they're going to come, again, for technology, and they're going to come for it in a big way. It's only going to get more interesting as the days pass over here. So Microsoft have also got an in-out spread. We are right on the dance floor for profitability on that in-out spread. Now, before I go any further, and I was detailing a little bit about tech and my feelings that tech have to get, crushed, right? One of the other things, and I'm getting a lot of questions about this, happens to be the VIX. So before we go any further into detailing individual positions, let's talk about the VIX for just a second. So one of the things that people don't really get is that today, okay, would you categorize today as a hideous day in the marketplace? Oh, yeah. I mean, come on. The Russell's down some 7%. S&Ps are off almost some 5%. That's what we categorize. Anything over a 3% move is statistically significant. But you start getting down to and close to a 5% move, that goes from statistically significant to absolute hideousness in the marketplace. So the question is going to come up inevitably. How come the VIX is only up some 6%? And the way to describe this, I'm going to give you a kind of a quick analogy. The marketplace, it's seen this one before. It's seen the movie before. And if you've never heard that phrase, traders use that phrase for, I don't know, I knew traders and I grew up around traders. Traders have been using that phrase for probably 50, 60 years. As long as movies have been around, traders have been using this analogy. But the way it kind of works is this. Let's actually cruise over to the spiders. Okay. The marketplace is not seeing anything today, right? It's down some 4 or 5%. The marketplace today, it's not seeing anything that it hasn't seen in its not too distant past, right? So look at this. You got days here like, oh, we're down 7. Oh, that was a big one. Oh, that was hideous over here. Oh, it was even more hideous over there. So what? You're down another 5%. Okay. The way and the analogy, okay, to give you is this. You're watching a really, really scary movie. This is it right here, the scary movie. And you're scared to death in that movie play. Something jumps out of the bushes. Okay. And that's why the VIX was spiking into the 60, 70, even 80 region, albeit briefly. And now you've got the VIX at 56. You want to know why? Because the VIX, all right, isn't going to react to the next down move. It's not going to react to the next down move. Why? It has already seen, okay, the terrifying movie before. All right. Now, will the VIX spike? Yeah, after we come under like 220. I'll tell you what, 220 inside of the spiders, the VIX will get rocking again. But until then, we've seen that scary movie. And you better remember that, because one of the things that I'll reiterate time and time again, the spikes up in the VIX, as I said, the 60, 70, even 80 handle in here, the spikes in the VIX are a flash in the pan. It's the first time you actually see the horror movie. After you've seen it a couple of times before, you're like, cool. Remember this. The market bottom doesn't come at a volatility high. I'll say that again. Okay. The market bottom. That is, if you take a look at the spiders and you're like, I think the spiders have bottomed. I don't believe it. And I'll tell you why I don't believe it. I don't believe it because the spiders at 218 saw a volatility high. Most market bottoms come, okay, when volatility has already subsided. Well, now volatility is subsiding and the marketplace is starting to sell off again. And that's something you need to get used to. All right. So again, if you're looking for higher volatility, well, don't be. All right. Because this is relatively normal. Now, let's actually spin it around to a couple of individual symbols here momentarily. All right. Of course, everybody's going to ask me, what do you think the market's going to do over here? Listen, okay. In volatility, in periods like this, and I'll come back and actually knock this back to the 30-day 1 hour. For the time being, just seeing where we traded to the end of the day. Look at this, less than 2 million contracts traded today, okay? For the foreseeable future, we've got gravity points, and we're going to ping between these gravity points. And this lower gravity point is 2411. Frankly, okay, we've been below that and below that recently. All bets are off under that 2411. That's when markets are going to start to break down, start to get a little bit wild over here. Now, of course, everybody's going to ask, do I anticipate getting lower, okay, than this 2174? Yeah, but maybe not necessarily tomorrow, okay? I think we have some really difficult times ahead of us in the next 3 to 4 weeks of trade. April, it's not going to be a happy time, and it's because, well, some of the data is going to start to come out. Now, we might get an employment report this Friday, and the employment report could be absolutely hideous. I'll tell you what, it's not going to be hideous because the employment report doesn't count all of March. It only goes up to about March 12th. So that's one of the things that's kind of hidden in the employment report. Don't get too excited. The data that you're getting out of the employment report this Friday, and I'll watch it, but I'm not going to get excited about it. The data you're going to get out of the employment report this Friday is it's already depreciated. No one really cares. Okay, the data though that's really going to start to matter is when it starts rolling out in April. And by the way, there's also if you take the 2008 playbook, there's a pretty good chance that well, they may decide to not release certain data, okay, to the public or privately for that matter. They may withhold some of the data because it could be that ugly at that point in time. Nevertheless, okay, we fully anticipate that the effects of what we're seeing of an economy this economy hasn't been stalled out, okay? It's dead. I mean, they just stopped it on a dime. Nothing like this. There's nothing to compare. People will pull analogies from '08. Yeah, I get it. Like, we're using the '08 playbook, but that's for the Fed, right? That's for the bailout plans. The marketplace, there is no playbook at this point, and you need to be aware of that. So for the time being, yeah, I remain in a little bit more of the bearish camp, okay? Does it mean I have a lot of negative deltas? No. I'm actually not taking that many bearish positions. I'm taking a couple of bearish shots here and there. I'll actually go over some of those bearish shots. I have a bearish position on right now inside of Boeing, right? It's down $18 today. That Boeing position is now deep in the money. So we'll see how that comes to fruition in the next couple of days. The next bearish position, of course, is in Microsoft. I've already highlighted this. This one's right on the dance floor. Okay, the other bearish position, of course, I talked about this on Monday night. It was the title of the video on Monday night, and that was in HYG. I see huge opportunity in here. I have two different positions in HYG. One of my positions in HYG is just an in-out spread. I even teed this one up the other day. I didn't even execute it until the day after. So I executed this yesterday. As I said, you had ample time to get in. Don't tell me you can't get into a position. I got into the position the day after I mentioned it on this video. So there I am. I'm in a bearish position here. In fact, this one's right almost primed to close already for a profit. But I've also got a duration position on in here. When I say a duration position, I have a deep in the money put. It's synthetic short stock position. And it's, well, this one's just knocking it out of the park right now. It paid $9.47. It's up to about 16 on a few contracts in there. From this point forward, though, again, I still fully anticipate more sell-side activity to occur. Be careful of some of the rip-your-face-off rallies. Opportunities are going to be coming. And when I say opportunities, some of the opportunities I'm going to be looking for in the next few weeks, I will find some long opportunities. Stuff that has like 200 and 300% implied volatility. Ooh, we're going to go out. We're going to sell some premium. We're going to get long a couple of stocks. Okay, this is what this is what volatility traders are about. Like, we live for this stuff. And no matter how horrific some of the events are going around us, try to separate yourself from it, because I'm telling you right now, you're getting a once-in-a-lifetime opportunity that's coming. And I'm going to tell you, you don't have to jump on it, necessarily today, tomorrow. The next couple of weeks, you're getting a once-in-a-lifetime opportunity. And there's something I've thought to myself, and I've thought to myself for the last, almost 12 years. I always thought 2008, 2009 was a once-in-a-lifetime opportunity. This is going to be even bigger. And again, I'll reiterate that all day long. This is going to be bigger. There's some companies that are obviously not going to make it. You do not want to put your neck on the line on any one product in here. I can't reiterate that enough. Your opportunities are coming, and they are coming to you, okay, fast. Volatilities are high. We're going to take a couple of positions, though. Be patient, okay? you haven't necessarily seen ugly yet. Let's remind ourselves, okay? Right now, there's no economy, there's no clarity. But the S&Ps, they're still near 2,500, okay? Near 2,500. And one thing I try to be mindful of is I want to pull up just for a second, okay? Just a 3-year chart inside of the S&Ps. We're right back down there, right? Now, you start to pull up a 5-year chart, and you ask yourself, okay? You really do have to ask yourself this question. Are we better off now than we were 4 or 5 years ago? Because you can see the S&Ps, these spiders, right back down to $180, okay, without batting an eye. Things are serious right now, okay? Step out, take opportunities as they come, trade small, stay small. In many cases, some of you are going to have to be defying risk. That is fine. People, okay, this is all out volatility, all right? It's every man, woman, and child for themselves. Again, you thought the sell side activity may have been over. You were dead wrong. This is the opportunity coming to you. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.